Right. So for this particular session, right, we want to look at a calculation of gross of the taxable income of a company. Right. We want to look at the calculation, right, of the taxable income of a company. Right. Remember, let me correct this. Right. I was saying, remember, when an entity makes a profit from its trading activities. So when you are running a business and you make a profit, right, you are supposed to pay tax. And one of the taxes that you pay, right, is what is called the taxable, or sorry, is what is called the company tax, which is calculated based on taxable income. Right. So this amount, taxable income, right, is used to calculate, right, company tax or tax for a company or corporates. Right. The tax is calculated at a rate of 27%. Right. 27% of the taxable income. Right. So if you want to know how much a company should pay as tax at the end of the year, you need to first calculate a taxable income. So I wanted to say taxable income here. You need to calculate this figure called taxable income. Right. Once you have the figure of taxable income, then you just multiply it by 28. It will tell you the amount of tax that is payable to SARS for that company for that particular year. Now remember
Sorry,
the
sir.
yes, ma'am. Mhm.
Did you say 28% or 27%?
It's currently 27. It changed. It was previously 28. It's now 27. Right. The year of assessment of a company is the same as the financial year end of a company. So if you have got a company, right, whose financial year ends on 31 December, then your tax year also ends on 31 December. If you've got a company whose financial year ends on 28 February, then the tax year also ends on 28 February. So it simply mirrors the company's financial year end date. So the financial year end of the company is the same as the tax year. So when we calculate to say this is the tax for the year 2023, it can be ending in July, in April, or any day as long as it mirrors the financial statement dates for that particular company. Right, to calculate this thing called income tax, we have got what is called the income tax framework. So this is a structure that gives you a guide on how to calculate income or taxable income, and eventually, of course, the amount of tax. So the first thing that we've got to deal with is this thing called gross income. So you need to know how to calculate gross income. This is the first building block for the purpose of calculating the taxable income of an entity. You must start by calculating gross income. Right, there are two considerations, or there are two ways in which an amount can be included in the gross income. Number one, by meeting the definition of gross income. So any amount that satisfies the definition of gross income will be included in the calculation of gross income. Right, there are certain amounts which are received by an entity which may not satisfy the definition of gross income, But in what is called tax legislation, we have got what is called the Income Tax Act. These amounts are specified that even though they don't satisfy the definition of gross income, they must be included. So we call these specific inclusions. Right, these are listed in the Income Tax Act to say even if they don't satisfy the definition, you must still include them. Then we list what we call exemptions. Now remember, the inclusion of an amount in gross income will inflate the taxable income amount, which means normally it should lead to a bigger amount of taxation. So whenever you add an amount to gross income, it may have the impact of increasing the taxable income, which in turn increases 27% of that taxable income. Now, SARS does provide some form of relief at times on certain amounts that are included in gross income, which means you can actually remove a certain amount, maybe a portion of or the full amount included in gross income. So these are exemptions, which are amounts included in gross income, which you are then allowed to deduct in the calculation of what? Of taxable income. So these you deduct. And when you deduct this amount, it then gives you what we call income. So whenever we talk about income, just plain income, in the calculation of taxable income, it is gross income for a period minus exempt income. Then you get the income. Now, this is similar like a financial statement in accounting. So we need to go on and less what we call deduction. We don't have this thing called expenditure in taxing. We call these deductions. So normally we say allowable deductions. So these are like what we call expenses in financial accounting. We don't have that term expense. We have deductions in tax. Now, there are three ways or three situations that give rise to allowable deductions. We have what we call general deductions. Right, we have what we call general deductions. Number two, we have, can correct that. So that is general deductions. Right, then we have what we call specific deductions. So with the general deductions, we have something called the general deductions formula. So it is defined in the Act. Any expense that satisfies the definition of general deductions formula will be included as part of the general deductions. But there are other expenses which don't satisfy the general deductions formula. Now, some of those expenses are specified in the Act to say, even though these expenses don't meet the definition of the general deductions, you can still deduct them. So it's a list provided by SARS in terms of the Income Tax Act. Then we have what we call capital allowances. Now, capital allowances are similar to what we call depreciation in accounting. There is no depreciation in taxation, but we have capital allowances. So SARS has got its way of calculating what we normally call depreciation in accounting. It's called capital allowance. And usually for a particular asset in accounting, the way of calculation in taxation and the figure may differ, but we do have what we call capital allowances. So once we remove the allowances, then this is going to give you the taxable income right before allowable capital gains or before capital gains. Right, then you say you add the capital gains. Right, and then you get taxable income before donation. Right, taxable income before donations. And then you say less section 18A, donations. So certain donations that a corporate company makes allow that company to reduce the amount of tax that they pay, but they must be what is termed Section 18A. We'll learn about that as we go along. So then we are able now to then get the taxable income. So if I want the amount of tax to pay, I will simply multiply the final amount of taxable income by 27% in the current year. In the prior periods, it was 27%. So this is what we call corporate taxation. Now, your module, besides VAT, the major part of the syllabus, you'll be covering the framework for the calculation of income tax. This is a topic on its own. You need to know how to deal with the gross income. Right, once you're done with gross income, you go to exemptions. You learn what exemptions are available. Next, you then go to deductions. This is a lesson or a topic on its own. This is a lesson on its own. This is a lesson on its own. So we'll spend a lot of time here. Capital gains is a lesson on its own. If you do these stages of the framework from start to finish, if you understand everything, you would have done almost 80% of the syllabus. Then you will get a question in the exam which wants the long calculation one, normally 20 marks. But you will still get other questions also coming from the framework. For example, you can get a question on gross income on its own. It normally comes as theory, about 10 marks thereabout. Allowable deductions, all the areas right up to the end. This is the bread and butter of the module. If you are doing 2601, you do a lot of theory questions there. Some of the questions will ask you specifically on the framework. They will say in multiple choice, income or gross income minus exemption equals to, they'll give you 5 options. You choose the correct one, right? Or they will say, in order to calculate taxable income, you add capital gain or you subtract, or they say you subtract capital gain, true or false. So you need to master the framework as it is for your multiple choice questions. If you're doing 2601, you get a lot of questions. You know, they normally give you 50 questions for an assignment. Maybe 5 of them will come from this. Just knowing the layout of the structure and be able to explain that if you say gross income, less exemption, less allowable deduction, it gives you taxable income before capital gain. You get marks for that. So let's make sure that we master the format. It's like learning how to calculate the gross profit or the net profit in financial accounting. You have to know the structure that you start with sales revenue, you go to cost of sales, you go to expenses, you go to profit. So you can't calculate here if you don't know the sequence of the framework. Very important. Right, once we have that, our lesson today is on the first part there, which is gross income. Right, gross income by nature is normally a theoretical question. So you normally get a question, you get it either in the assignment or you get it in the exam where they will want you to deal with gross income from a theoretical perspective. Otherwise, you deal with it in calculations when you calculate this amount. Of course, you start by calculating gross income, but there is usually a specific question, theory type, that deals with gross income. Now, when you deal with gross income, the first thing that you must do, right, you need to understand that we have 2 types of taxpayers. We have got 2 types of taxpayers. Now, please remember that in this module or in these modules that we are doing, right, we deal with corporate taxation for now. right? We are not yet dealing with individual taxation. Remember, there is taxation for companies, there is taxation for individuals. So Tax 2601, 3701, you deal with corporate entities only. Then Tax 3761, you deal with both individual taxation and company tax. But for now, I'm dealing with situations in company tax, individual taxation next semester. So there are two types of taxpayers that we have, right? We have what we call, right, a resident. Right. So when you talk about a resident in the context of a company, right, this is basically a company, right, which was, number one, formed or incorporated in South Africa. So if there's a company that was formed or incorporated in South Africa, then that particular company is a resident of South Africa. Or you've got a company which may have been formed elsewhere, but effectively is managed from South Africa. Right. So when you say effectively managed from South Africa, you may find that a company could have been formulated in the United Kingdom, but we are saying that the key management personnel of that entity are domiciled in South Africa. Board meetings are held in South Africa. The major decisions of the company are actually decided here in South Africa. So therefore, even though the company was not formed here, but we are saying effective management of that entity is found in South Africa, it will be also determined as a resident of South Africa. Now, the key thing about the resident of South Africa is that residents are taxed on a worldwide basis. Right, residents are taxed on a worldwide basis. So what it means is it doesn't matter, right, where you are in the world and where you earn income. If you are a resident of South Africa, you must pay taxation in South Africa, as long as you still carry the citizenship of the country. So you may be a citizen here, then you decide to go and do some work in the United Kingdom. Maybe you're consulting there. You earn a little bit of money while you are there. You are still within the reach of SARS. You should pay tax. You are still a resident. So as long as you are a resident, you pay on a worldwide basis. Unless if there is what is called a double tax relief agreement between the country where the source of the funds came from. Now, a double tax relief may occur, maybe say, between South Africa and Britain, where they make a specific arrangement to say when a resident of South Africa works in the UK and earns money, right, he will not be taxed in South Africa. South Africa will let Britain tax that individual. Then, in return, the citizens of Britain, if they come to South Africa, they work in South Africa, Britain is not taxing them. South Africa will tax them. So that's a double tax relief agreement, which prevents the same amount of money to be taxed by two countries. But there has to be an agreement between the two countries to that effect. If there is no agreement, you simply pay on a worldwide basis if you are a resident of South Africa. Are we clear, good people? We have what we call a non-resident. Right, so when you talk about a non-resident, this is a company that is not a resident of South Africa. Right, so this is basically a non-resident. So it means they don't satisfy all the requirements to register as a resident. So they were not, the company was not formed in South Africa. It is not effectively managed in South Africa. It's a non-resident. Now, when you deal with non-resident companies, these are taxed only on income sourced in the Republic. Right, these are only taxed on income, right, from sources within South Africa. So if you are a non-resident, if you don't earn any income while you are in South Africa from South African sources, you are not going to be taxed in South Africa. But if you earn income from sources in South Africa, for example, you come from another country, you do consultation work, SARS will need a portion of that income in the form of taxation because you are working within their jurisdiction. But any income from elsewhere as a non-resident and come with it to South Africa, you can enjoy your money. You are not going to be taxed on that money while you are enjoying it because it was never sourced from South Africa. As a non-resident, you don't pay on a worldwide basis. Right. Are we clear about that, good people? Any question?
Sorry, sir. On the double tax relief, so let's say they don't have that agreement where you're double taxed. You're
Mhm.
not double taxed in countries. Does that mean you pay tax to both countries then?
100%. If the other country is charging you tax, you pay there. So it depends on what the other country says. But if you are a resident of South Africa, you go and work in Britain. Britain taxes you. You come back to South Africa. If there is no agreement, we tax you again. So you'll be taxed twice on the same income.
So then what's the incentive here now?
To go and work outside, maybe the income is a bit steep there. Even if we tax both sides, you still are happy with the amount. Maybe, I don't know.
Oh, okay. Thank you.
Yes, yes, yes. Thank you. Right. So the reason why we explain these terms is because whenever we deal with gross income, remember we said one of the ways in which an amount can be included in gross income, it is by way of definition if it satisfies the definition of gross income. Now, the definition of gross income is divided into two. One part is for residents and the other part is for non-residents. So let's look at the definition of gross income. Right, let's look at the definition of gross income. Right, so when you look at gross income, the definition says, right, in relation to any year of assessment, right, in relation to any year of assessment, right, can't write why, right, in relation to any year of assessment. Right, gross income means. Then the first part now, so you have part one, this is in relation or in the case of a resident. Right, in the case of a resident of South Africa. Right, so when we define gross income, we then say it means, right, the total amount, right, the total amount in cash or otherwise, right, received by, right, accrued to or in favor, right, of such a person, right, or number two, in the case of any other person, right, in the case of any person other than a resident. So this part is talking about non-resident. That's what it means. I don't know why in their definition they didn't just say non-resident, but they are talking about a non-resident. So any person other than a resident, it means non-resident. Right. So for this one, we are saying again, the total amount right, in cash or otherwise, right, received by, right, accrued to, or in favor of such a person. Then we add from sources within the Republic. Remember, non-residents are taxed on income from South Africa. So we had to specify that for non-residents, we are specifically saying on income sourced within the Republic. Right, but in the case of a resident, we are not specifying anything. So we just say any income that you receive, which means income from any source within that you receive within a particular year. Right. So the definition is divided in two parts. Then we have the last part of the definition, which covers both a resident or a non-resident. Right. Then we say excluding receipts of a capital nature. Right. So all income received for both resident and non-resident except receipts of a capital nature. So receipts of a capital nature will not be included in gross income. So what it means now, you must understand, remember, an amount that satisfies the definition will be included. So you need to have in-depth understanding of the terms used in the definition. So we want to go to that definition and say detailed explanations, right? Detailed explanations of the terms. Right, used in the definition. Right, starting with the year of assessment, I've already explained that, but I'll just put it in notes. Right, remember the definition mentions the year of assessment. Right, so when you talk about the year of assessment here, right, this is the same as the financial year of a company. This is the same as the financial year of a company. Right, so remember we said if a company's financial year is ending on 31 October, then the year of assessment of the company will also end on 31 October, which means it starts on 1 November. If it ends in December, that is the financial year end, then the tax year of that company for the purpose of taxable income or income tax starts on 1 January and ends in December. So we then say any income, right, any qualifying income. Remember, income qualifies based on the what? Definition or specific inclusions. Right, either on the definition or specific inclusion. Right, should have been earned right in that year of assessment. So you can't have a claim of income that did not originate in that particular year. And if you are supposed to claim income in a particular year, but maybe you were not very clued up on whether that amount is supposed to be included or not in gross income, right? When it's deductions, sorry, when it's deductions, that's when what I was about to explain applies. If it's income, if you don't include it, if SARS finds out, they will penalize you and they will reinstate the amount. But if it's a deduction, they won't. But we are talking about income here. If it's a deduction and you fail to claim it in 1 year, you can't go back and say, I'm claiming this. I forgot it last year. They will never allow it. But income, they will make a follow-up. They don't play because you'll be producing the what? The state coffers if you don't include an amount in gross income. Right. So an amount must have originated in the current year to be included in the current year. Right. For an amount to be included, right, for an amount to be included in the current year, right, it means that it must not be, there's a word that I'm looking for. Right. I will explain what it is. I've forgotten the word. It must not be dependent on future events yet to occur. That is to say, there must be no condition needing to be satisfied. Right. For example, let's say I do work for someone. I contract with a student, right? And in my contract with the student, right? Sorry. Right. Let's say I contract with a student to say, I'm going to teach you a module. My fee is 3,000. And we do it at the beginning of the year. But the exam is at the end of the year and the results are in the following year. I then say, this is what I'm charging you, and I invoice you as a client. End of the year is 31 December of the year 2025. The results are in January. My financial year end is here in December. Right. I then say to the student, however, this amount is payable if you pass. If you fail, then I will not charge you. So it means that at the end of the current tax year, I've got this potential amount of income, but it has got a future condition before it is realized. So before that condition, which is to say the student must see the results, and if he's passed, then he owes me, he must pay. On 31 December, we are saying there is a condition that must be satisfied first before the invoice realizes. So at the end of the year, there is no income earned. Right? The income will be earned in the following year, in January, when the students see their results. If they find out that they have passed, then the students can then what? Pay me. So therefore, this income does not fall in the 2025 year. It will fall in the 2026 year of assessment. So as long as we have got a certain amount of potential income, however, there is a condition that must be satisfied before I realize that amount as the person who is supposed to earn it. It doesn't belong in the current period. It belongs in the period in which that particular uncertainty, that condition has been cleared. Are we clear about that, good people? Right. Are we on the same page?
Yeah.
This is what we mean by year of assessment. You have to know in which period is a certain amount or transaction going to fall into. As long as it occurred in the current year and there is no condition that is yet to be satisfied, it will fall within the current year. But if the transaction originated in the current year, but there is a condition, as long as that condition is not satisfied, then it is not going to be recognized in the current year. So that is what we are talking about. Right, one more thing, an amount is recognized. Right, an amount is recognized at the earlier of receipt or accrual. right? Accrual is when there is no condition which may prevent uh, which may prevent collection. In other words, there is no uncertainty. There is no future event that needs to be satisfied. Right? There is no uncertainty there. We are very clear the amount is owed. Right? There is no condition or uncertainty preventing the collection of the amount. Right? So when we talk about accrual, right, I've given an example here of 31 December. Right, 1 minute. Right, I've given 31 December as my fictitious year of taxation. Let's say I have invoiced a client, right, 10,000. Right, so in scenario number A, let's say I then supply, right, goods, right, on 25 December of the year 2025. Then the client pays and they receive payment. Right. So let's say I received the income, or I was paid on the same day, 25 December. So here the receipt is within the year, 31 December of the year 2025. Right. And the amount that I'm supposed to pay accrued to me on the same day as the one providing service. Right. So accrual is also on the same day, 31 December. So there is no problem as long as there is no condition that must be satisfied. This falls within 31 December. Right. I can have a situation where a customer pays me. Right. I receive income in advance. The client pays in advance on 25 December 2025. But I deliver my side of the bargain next year on 2 February of the year 2026. Right here, receipt of the amount is 25 December, right? But accrual of the amount to me was actually in 02 February. This is where the amount was due to me. I should have been paid on the 28th of what? Of February. Accrual is when you have satisfied your obligation as the supplier. You have delivered what you promised to the client, and you are now due for payment. That is accrual, and there is no condition that prevents accrual. So this transaction will then fall again within 31 December because it is any of the earlier of receipt or payment. As long as it occurs within the current year, you account for it in the current year. Right? It can happen also that you deliver goods, right, on 25 December, but your payment is payable, right, on 31 January of the year 2026. This is 2025. Right, so accrual in your hands. Right. Accrual is when you are unconditionally entitled to an amount of money. Right. So unconditionally entitled. It simply means that there is nothing that prevents you from collecting the amount. In terms of law, you have delivered the product, you are due for a payment. There was no condition that was put to say this must happen first before the amount accrues to you. So this accrual is actually on 25 December when you deliver the good. Then the amount can be delayed in payment, but it is accrued to you. Right, payment can then follow, which was done on 31 January of the year 2026. The question therefore is, where does this amount fall? Does it fall in 2025 or does it fall in the year 2026? Now we are saying what happened first. There was accrual in the current year. This transaction will fall within the 2025 year because it is the earlier of receipt or accrual that determines where the amount should fall. Right. Are we following on that, good people? So you need to know when you deal with a certain transaction, whether you are going to account for it in the current year if it's 2025, or you need to account for it in the year 2026. So if they say calculate the taxable income for the year 2025, you must know which amounts belong to 2025 and which amounts don't belong. They belong probably to the next period. So this is important to understand. Any question? So earlier of receipt or accrual of the amount. Then if we
Sorry.
go, yes, ma'am.
Okay, so let's say, so what I'm thinking then would be, so if I have stuff that I need to deliver on the 25th, so I might just as well wait until the 31st, because if I deliver it, then I have to account the tax for that year, even if I'm not paid for it,
Yes, you have to account for tax in the current year because you have already delivered and you have become entitled to the what?
to the
Consideration.
amount.
So it all
Oh, okay.
now whether your client can wait for you and you deliver later, or the client is someone maybe who is on a 30-day payment with you or 60-day payment with you. They've made an order just towards the year end. Right. What are you going to do? Are you going to say, I'm not going to deliver, I'm going to wait for the year to end so that I don't pay tax? You may lose the client. Ne? So you may be forced to deliver the goods to the client because you want to keep business and the client happy, but you have already signed terms that say the client is given 60 days to pay. So you will have to wait, but unfortunately, you will have to account for tax in the current year. So it's a tricky one, but that's how it works. Earlier of a receipt of the amount or accrual of the amount. Accrual is when you have delivered and you are unconditionally entitled to the amount, even though it's not going to be paid in the current year. So you have to be clear about year of assessment. It's not as easy as just saying financial year end. You have to look at the permutations. Right? I could have delivered. For example, I said, I am a tutor. Right? I say to the student, your fee 3,000. This amount is payable on receiving results on 31 January of the year 2026. This is where the payment is expected. But I've already invoiced my client 3,000. Right, this is payment. What about accrual? Now, this has not yet accrued to me because we are waiting for what results. So there is a future uncertain event which may prevent me from eventually receiving the money. So even though I've started to deliver my work and I've invoiced the client, it cannot be included in the current year because there is uncertainty on the amount. There is a future event that needs to be satisfied first before this amount can be recognized in the current year. So this will likely fall in the year 20 what? 26, when the results come and say the client has passed. Then I'm due a payment. Right, guys, all right.
Yeah, but also now let's say you say we deliver it and then we're supposed to be paid on the 31st, right?
Yes.
And then the customer doesn't pay us and we've already paid our tax and everything.
I
Then
remember
what happens?
Remember, we have also what is called a bad debt. It is an allowable deduction. Ne? So you will still receive your money back in the form of allowable deduction. So when we calculate the taxable income, where is my format? When we calculate the taxable income here, right, where is it? Right here. So if I include an amount, let's say I've sold goods and they are worth 2,000, right? And I've sold them on credit, I'm expecting the customer to pay. But the customer eventually fails to pay me, right? As part of the general deductions, I'm allowed to claim a deduction in terms of bad debt. So which I will separate. So it will be in and out. It may be out maybe in the following year, not in the current year. If I claimed in the current year and I only discovered in the following year that the client will no longer be paying me, I will then claim a bad debt in the following year. So just like what we have in accounting, where we have a bad debt as an expense, we also have bad debt here as a deduction. So you will still be, it will be reversed, but via a bad debt. Right?
Okay, thank you.
Yes. It will be reversed as a bad debt. Right. Please hold on, please hold on, please hold on. Right. So that is basically what you must remember when you discuss gross income. Maybe they ask you in the form of a theory question. Sometimes they ask you, they will give you a transaction and then they will say, in which tax year is this amount going to be accounted for in calculation of gross income? Then you need to be able to check and say, is there a condition that must be satisfied with this amount? If there is no condition, then you say, when did the earlier of payment or accrual occur? So you'll be discussing that and you probably earn about 5 marks for that discussion. So you need to be very clear on that. Right, when we look at the gross income definition, we have explained one thing here. We have just looked at what is called, right, year of assessment. That's what we discussed today. Next, we want to discuss this issue of in the case of a resident we have already discussed. So we want to discuss this, the total amount in cash or otherwise. So therefore, that's the next item to discuss. Right, the total amount. Right, in cash or otherwise. Right, so this part of the definition is also very important. All the items of the definition are important. You need to be very, very clear. Right, so we are saying what is included in gross income may include transactions where of monetary values or barter exchange. So amounts of monetary transactions, right, and non-monetary transactions are included, right? For example, barter exchange, right? When entities transact, they can transact in monetary terms. You deliver a product, you charge a cash amount, and you receive cash. So that's in cash. Or otherwise, instead of receiving cash, you do barter exchange. I think barter exchange must have a double T there. Right? When you do barter exchange, right, that is non-monetary, right? Exchanges should be converted into equivalent amounts in cash. Right, should be converted to equivalent amounts in cash. right? So as long as the monetary amount can be established, then it will be included in the gross income. So you can, for example, provide the services or a service that you actually provide. Let's say you provide the service to SAPC. Then in exchange, SAP says they won't pay you, but they will flight you advertisements free of charge to the value of the amount that you are charging. So that is barter exchange. As long as we know that SAPC charges so much per advert at this particular time, and we can quantify the amount of airtime that you got, then we'll be able to determine the equivalent monetary value, and that will be included in your what gross income, even though there was no exchange of cash. Are we clear about that, good people? So it is the total amount in cash or otherwise, and then they continue and say, right, accrued to, right, in favor of, right, or let me say the first wording there is amount received by. There are three words that we have got to consider, right? Received by, accrued to, right, or in favor of. Right, so here we are saying what can be included in a taxpayer's gross income. Right, we're saying only amounts received by or accrued to. Remember, received by, you have received the amount of money. Accrued to, you have become unconditionally entitled to an amount. So amounts received by, right, or accrued to a taxpayer, right, should be for the benefit and use of the taxpayer. To be included in gross income. Right, to be included in gross income. Right, it is quite possible that someone receives an amount when amount accrues to someone, but it is not for their own purpose or benefit. They are holding it in trust for another. So the amount is taxable in the hands of the person who is going to benefit from the use of the amount. For example, if you run a law practice, right, you collect monies, but they are not yours at times, they are collected on behalf of clients. Right, eventually those amounts that you receive and accumulate in your trust, you will have to release them to the relevant what? Client. So therefore, you received the amount, or the amount accrues to you as the law firm, but it is not in your favor. It is in the favor of another. In the favor of another means another person will benefit from the amount, not you. So therefore, it will be included in the tax of the eventual recipient who is going to benefit from the use of the amount, not in the hands of the taxpayer. You are in charge of a minor, and the minor earns income, but it is released in your trust. Of course, you receive the amount, but it's not yours. It is in the favor of the minor. So if there are systems to tax the minor, then it will be taxed in the hands of the minor. Maybe the minor is the beneficiary of a trust. So the trust will be taxed, not you. It can't go into your gross income. Right, are we clear, good people? Right, the amount must be received by or accrued to and in favor of the taxpayer for it to appear in the gross income of that taxpayer. If it is not for the benefit of the taxpayer, it's going to accumulate in the hands of someone who is the overall beneficiary. So that is how this one works. Right, so we have explained, we have said the total amount in cash or otherwise received by accrued by in favor of such a taxpayer. Right, then we are saying excluding receipts of a capital nature. Right, so we want to talk about the receipts of a capital nature. These are not included. Right, the receipts of a capital nature. Right, we distinguish between two types of receipts. Right, we distinguish between two types of receipts. Right, we have what we call revenue receipts. Right, so we have revenue receipts. Right, we also have capital receipts. So we have two types of receipts that we have. The revenue receipts and the capital receipts. Right, your book here, or your textbooks, or your text material, they normally give the example of an apple tree. Right, there is the tree itself, there is the fruit. Right, income derived from the sale of the tree. If you decide to sell the tree, that is capital in nature. Right, and then the fruit itself represents revenue in nature. Right, so that is how they explain it, trying to simplify this. It can be an example, for example, let's say you have got a house that you rent out. The house itself, that's capital receipt. If you sell it, it will give you capital receipt should you decide to dispose it. Then the rent here represents revenue. So when you collect rental on the house, that is a revenue receipt. But when you decide to sell the house, that is a capital receipt. If you have got a tree, apple, and the fruit, the sale of the tree is capital in nature, and the sale of the fruit is revenue in nature. So this is how we explain it also here. Right? When we talk about capital receipts, this is proceeds from sale of income producing assets. It's like when you sell a non-current asset. Remember, a non-current asset is an asset that produces income. Should you decide to sell it, then it gives you a capital receipt. Revenue is the sale of produce of capital assets. A capital asset is an income producing asset. So should you sell an income producing asset, it's capital revenue. So it's capital receipts. So capital receipt is the proceeds of the sale of the asset. But if you sell the fruit or the produce of the capital asset, that is revenue in nature. Now the logic is very simple and easy to understand. Let's say you happen to have R1 million. You happen to have R1 million on you. Right, you don't receive an amount without SARS taxing you. Maybe this amount was pension from employment. When you receive your pension, SARS is going to tax that particular amount. So therefore, the final figure that you have here has already been taxed and SARS has taken its portion. Or when you are a beneficiary of a deceased estate, right? When you have a deceased estate, ushonile umzali or someone close to you, they leave you or they bequeath you with an estate. SARS will tax that estate. What you then get yourself after the taxing is the gross amount after removing the tax that is payable to SARS. So whenever you have a lump sum, SARS is taxed. If you collected it from salary and you were saving it, maybe you earn a lot of money every month, you were saving 200,000. You ended up going to what? 1 million. Remember, when you earn your money from employment, SARS takes something from employment income. If you are compliant with taxation, you don't get to have a sum of money without it having been taxed already. Are we clear? Right, are we on the same page?
Yeah.
Right, you take that amount, you buy a house for rental. Right, your 1 million, this amount has already been taxed, has been converted into a house, which is worth 1 million. Right, over the years, you collect rent. Maybe your rent that you collect is 20,000 per month from that property. So what we are saying is your 1 million that has already been taxed is still protected here. It's in the house. But this extra amount that you get here has not yet been taxed. So when you earn this, we must remember that revenue is included in gross income. So which means this amount is going to be taxed because it was never taxed. This is new money that you have earned. But when you sell your capital asset, this is excluded from gross income. This is excluded from gross income. Right, so therefore, as you are earning the rent income, SARS will be busy with you. They will want their percentage on that rental income. You have to include it when you calculate your individual taxable income if you're not a business, if you're an individual. When you calculate the amount to pay to SARS yearly, you must include that amount together with your employment salary and other sources. But it may yet come that maybe after 5 years, you decide to sell the house. Right, maybe you sell it for 1.5 and the house never deteriorated in value. Now remember the original cost of the house was what? 1 million. SARS will then say, what is the proceed? Original amount received. What is the cost of the asset? Then they will have a difference of 500,000. This here is what we call capital gain. This is when you sell your capital asset, which is an income producing asset, at a price that is higher than the original cost. SARS is simply saying this amount is returned back to you. It is this amount which you converted into a house and then it came back to you included there. But we are saying this portion has already been taxed. So SARS will then look at the additional amount that you earned. That's capital gain. This amount, SARS is going to tax it. Right, but if you sold the house and you sold it for 100,000, right, remember you had your original 100,000, that had already been what? Taxed. So there is no extra income. We are saying this 1 million, sorry, not 100,000. This 1 million is the same as this amount that SARS has already taxed. So they will not double tax this amount. So therefore, you can't include this amount in your gross income. it is excluded because it has already been taxed. If you have an extra amount, which is the capital gains, this amount, which is capital gains, will not be included initially as part of gross income. You don't include it in gross income. So the whole amount here does not go to gross income. But SARS uzokubamba ke lapha because in your calculation of taxable income, there is a room for that figure there. You see, they say at some point, add capital gain, which means it's going to contribute there. You are going to be taxed on the extra amount that you earned, which is capital gain, but it is not included in gross income at all because it has got its own slot elsewhere. That is the capital gain in that calculation. So we must remember that any amount of capital receipts which is on the sale of an income producing asset, simple put, on the sale of non-current assets in accounting. You don't include it in gross income. Now, this thing is accounting. You see, in accounting, when you have income, when you sell your trading stock 1 million, it goes straight into your what? Revenue. But when you sell a motor vehicle and you receive 100,000, you don't put the whole 100,000 in income. What you put in income is profit on the sale of assets. Are we aware of that? If I've got an asset, I bought the asset for 20,000. I have since depreciated by 5,000. I am left with 15,000. This is carrying amount. I then sell it for 27,000. This is proceed. In accounting, minus the carrying amount, which is 15,000, then I'll get my amount here. 27 minus 15, I'll get 12,000. What is this? This is profit on disposal. We know this in accounting, we don't include this in income. We actually include this amount. SARS will call this a capital gain and they include it via a separate line in the calculation of taxable income. In accounting, of course, we'll include that in other income. We are doing exactly the same thing, but we did not include that whole amount in income. So SARS and accounting, most of the time, the principles are the same. It's just the wording that differs. For example, we say depreciation, they say capital allowance or tax allowance, but we are talking about the same thing. Same here, they say capital receipt, but in accounting, we say this is just proceeds on the sale of an asset. So you must be very clear about all these things that we are discussing concerning the definition or concerning the gross income. Right, so any amount that is received by an entity which satisfies all the requirement and is not capital in nature, it will be included in the calculation of gross income. Right, an amount is included by satisfying the definition or by being a specific inclusion. Right, when we talk about a specific inclusion, it is any amount that does not satisfy the requirements of the gross income. Maybe we are talking about a capital receipt, which therefore ordinarily should not have been included in gross income. But we are saying these are amounts that were identified by SARS. They did not give us even a reason for why they are including them, but they identified these type of transactions and they said, if you come across this one, you should include in gross income, irregardless of whether it satisfies the definition of gross income or not. Number one is annuity. An annuity is receipts of same amount of money at regular intervals. right, for a limited period of time. If you leave your employment today and the company is supposed to pay you your retirement funds, certain retirement funds are not supposed to be taxed. So they are supposed to give you a lump sum, 5 million. Manje uyabona ukuthi 5 million you don't want to appear on television on how I blew it. Then you say to your insurer or your company that provides the insurance, instead of you giving me a lump sum of 5 million at one go, I don't trust myself. Can you please release it to me in amount of 100,000 per month until it is what? Finished. So it's now receipt of the same amount of money at regular intervals, which means on a monthly basis, up to the time that you finish the 5 million. So you are very wise if you are not trusting yourself and you know that you will upload the money and you say they must release it to you in bits and pieces. So 100,000 every month will last you 50 years. It will see you towards the end of your lifespan. Right. If the amount was not expected to be taxed and was not supposed to be included in gross income, as soon as you elect to receive the amount in annuity format, it is taxed when you receive it. Are we clear? Even if you sell your income producing asset and you've got a capital receipt, if you then arrange with the person that is supposed to pay you to say, pay me in bits and pieces, instead of paying me my lump sum, right, just make sure you send a little something. Let's say you arrange the payment via the sale via the bank, right? The bank then finds the person to buy and they finance that person. And then they have your money. They say, how do we pay you? You say, don't pay me a lump sum. Give it to me in 50,000 per month. It's now an annuity. So an annuity, regardless of where it came from, how it came to be, it doesn't matter. It is included in gross income. Right, number two, we also have, right, amount received in respect, right, amounts received in respect of employment for individuals, right, or in respect of service rendered. Right, or holding office. So this covers both individuals and corporate tax. Any amount that you receive in respect of providing employment or rendering a service. For example, I am teaching now, I'm providing a service. Right. It doesn't matter what in form and shape the money came in. It is included in gross income. So SARS was including this so that anyone who is providing a service, which is a business, any income that they derive from that business, they must include in gross income. If you are an individual and you earn money for providing your service for employment purposes or holding office, again, all of it is included in gross income. So you must remember that. So you won't even need to check what the amount is or what the amount is called, as long as it comes from rendering of service. It should be included in gross income. Then we have lease premium, right, and improvements. Right, a lease premium, right, when an entity is leasing out a property to another entity or to another individual, they sometimes charge a premium. A premium is an amount over and above the rental demanded by the lessor so that they can give a lease to a client. For example, let's say I own a property on a very busy street. My rent is 20,000 per month on that particular small property, right? But there is a bidding war from people trying to rent my property. I advertised it at 20 rand per month. That is the rental amount that I'm going to get. That one is included in gross income. It's the fruit of the tree. However, now because there is a queue of people wanting the property, I end up saying whoever wants the property pay 50,000 upfront over and above the rental amount. That's a rental premium or a lease premium. Again, a lease premium is included in gross income. Right, lease improvements. We agree with a tenant that when you go into the property, you are going to effect some improvements from your own pocket. Improvements is anything that increases the value of the property. So someone is buying a property, but the property does not have proper what? Car park. The tenant says, fine, I want this property, I'm going to put a car park. And they put a car park. So that is an improvement. An improvement increases the value of the property. Remember now, the client was not paying us as the lessor. With the company, the employee did not charge us for the improvements. So we have benefited as an entity on the improvement in the value of the property paid by the employee. It's an indirect rent amount. Right, you understand it? Right, are we clear? You are correct.
Yes.
Right, so any improvements done by a tenant which the tenant does not pay for, that's an improvement. It will be accounted for as gross income in the hands of the what? Of the lessor, the original owner of the property. So it should be included there. Dividend income.
Sorry, sir.
Yes, ma'am.
Would that then fall under barter trade? No, the improvement.
Would it fall under?
Barter trade.
Sorry. I'm missing you there.
Would it fall under barter trade then?
It's not really
The,
barter trade.
okay.
It's not barter trade. You know what happens with these improvements? I need these people
Mm,
to sit down and agree.
yeah.
Right? If someone is renting a property from me, right, and they're supposed to rent only for 1 year, right, and the rental amount perhaps is 20,000
Mm,
per year by 12 months. So it will be 20,000 by 12 months, which gives 240. You know what happens? This amount is taxable in the hands of the taxpayer. SARS wants a portion of that, isn't it?
yes.
So what people were doing before, because they will be trying to avoid the payment of tax, they will say, okay, calculate the amount of 240. Then they will say to the tenant, right, make improvements to the property. I want you to put a carport for 100,000. Eh?
Okay.
Right. So this is what people were doing. That's why it says it put this feature here of improvement being included. So someone will say to a tenant, okay, instead of you paying me rent, I want you to put an improvement on the property. I want you to build a certain structure, but we'll remove the cost from rent. I understand. Are you there?
Yes.
Yeah, so what people were doing was to calculate the total amount of rent and say to the client, make improvements. The client will make improvements of say 100,000 and then 140,000 will be the additional amount earned.
Okay.
So this amount is what the taxpayers were disclosing to SARS. But SARS then said, no, that is not correct. You actually received the full amount of rent there. You only hit it in the form of what? An improvement. Now
Improvement.
takes the rent and the improvement. Right, you understand it?
Mm,
So they
yes.
take the improvement and the rent and get to the actual amount of rent and there. So SARS has been busy refining their tax system. They look at the loopholes and they plug them.
Okay. All right.
Then you have government grants. Right? A government can give you a grant. If a government gives you grant amount, it is also included as part of the special inclusions. So whenever you see government grant, you must include it. Right. For corporates, most of the time, these are the items that go into the gross income calculation. So before you answer any question on the calculation of taxable income and in particular gross income, this theory must be on your fingertips. Then you answer. It's normally a very simple calculation. You just need to know which amounts to include, which amounts not to include. And you are done. Right. I forgot to add on improvements here. It is only the agreed amount of improvement. So if you, on the contract you sign with a tenant, you agree that he makes improvements of 1 million. If he makes improvements of 1.2 million, what is included in gross income is the original amount of 1 million. The extra amount will not be included there. Right. So you need to remember that whenever you come across an improvement, it's a specific inclusion, but there is a limit to the amount that can be included. Right, let's hold it here. So we'll continue next week, but we've already done the groundwork for gross income. So when we start, I'm going to bring a question of gross income. It won't take us even 15 minutes, will be done. 10 minutes, I think the question will be done, max. Then we shall continue to exemptions.
Alexa, you forgot to explain about the dividend income.
Our dividend income, remember, it's when a company is invested in another company and they are paid in the form of dividend. So
Okay.
the dividend that you receive, all of it, you must include in gross income.
Okay.
Right. So our next lesson, we are doing a question on gross income. That's where we start. Make sure you cover this theory and you are sharp on that, and then the question will be easy to understand. And then we take the exemptions. If time permits, we can go to general deductions. Right. Remember, we are following that framework that I gave you. So we want to make sure that at the end of the day, we're able to calculate taxable income. So we are here. Next week, we are here. If we finish that, we then go to general deductions. Then we move along like that until we finish. Right. Thank you very much. I shall see you when I see you. Thank you.
Thank you.
Sharp,
All
sharp,
right, thank you.
sharp.